Of the two inflation markers this week, PPI came in well below consensus, along with downward revisions to previous estimates. While a lot of macro data has been erratic due to businesses and consumers taking actions ahead of tariffs, today's CPI reading will hold sway on whether or not tariffs are impacting inflation. Now, to be clear, tariffs increase producer costs, which will be borne in some proportion by consumers in the US or supplier margins, and both have negative growth implications. And this is largely our reasoning behind expectations of a global growth slowdown. In the short term, though, the Fed's anticipated monetary easing is now clearly set to resume, and the question, as we've been raising for the last couple of days, is how much? And an even bigger related question is whether economic weakness plus easier monetary policy is better than the current status. We think not, but the markets for now think otherwise, pushing new highs even if it is on lesser breadth of participation. This push into new highs is also being led by growth sectors, tech, consumer discretionary, and away from value sectors. Clearly, markets are betting on monetary easing to the rescue and continuation of growth, especially in tech and specifically anything AI related. This divergence between the economy and markets will need to close the gap, either through the economy reversing its current downdraft or markets experiencing one. We've been in the latter camp, which is clearly now being challenged. Price action is going to decide whether the economy pivots or we do. This is Sunil Garg from Lighthouse Canton.